Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 33 on October 26, 2018. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Caesars Entertainment, Advanced Micro Devices, and eBay. And we discussed three new trades on Hertz Global Holdings, Teva Pharmaceuticals, and the VanEck Vectors Oil Service ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or about any of your own positions, feel free to email me anytime. You can email questions to eric@theweeklyoption.com. That's ERIC @theweeklyoption.com. And I've also created a short video series to teach you all the basics of option trading that you'll need to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel, the channel for the Weekly Option. This week was interesting. Several poor earnings announcements, some big ones were in Google and Amazon, led the markets lower, much lower. In fact, the Dow Jones Industrial Index finished the week 756 points lower, finishing at 24,688 points. That is nearly 3% loss week over week on the Dow. And then the S&P 500 index fell 109 points this week, a nearly 4% drop, and it closed at 2,658 points. Now this week there are 1,007 publicly traded companies that will be announcing their earnings. I'm not watching too many on Monday, but on Tuesday we will hear from Anadarko Petroleum Company, Baker Hughes, Aetna, GE, Caesars Entertainment. We'll hear from Pfizer, T-Mobile, Facebook, eBay, Hyatt Hotels, and Coca-Cola. So that's quite a few on Tuesday. On Wednesday, Allstate, Sprint, Kellogg, and General Motors will announce earnings. On Thursday, we will hear earnings reports from Apple, Starbucks, Shake Shack, CBRE, the real estate firm, RealPage, and MetLife. And then we'll finish out the week on Friday with Alibaba reporting earnings. So all of that being said, let's take a look at what happened this past week to the trades. Now, we'll start off just like we do with every week with the covered call. We looked at a covered call on Caesars Entertainment, symbol CZR, Charles Zebra Richard. The stock at the time was trading for $10.20. We looked at selling the November 11 call at 30 cents, hoping to collect a return of roughly 10% over the next four weeks. Now, the stock market obviously had a rough week, and that was no exception for Caesars. We did not get lucky with this trade at all. In fact, the stock fell $1.40 this week, ending at $8.80. Because we collected 30 cents to sell the option, our total loss for the week was $1.10. Now, you can always buy in the November 11 call and roll to a lower strike by selling the November 9 call. But honestly, I would exit this trade if you entered it. I'm not one for covered calls. I only really mention them on this show because this is one of the most basic trades that people use to get into option trading. So I think there's a value for them. If you already own this stock, then they can be a great way to collect some premium for stock that's already sitting in your portfolio. But I'm not always a big fan of entering them. That being said, I cover them each week. There are times when they make great money, so I'll continue to cover them. But just keep an eye out on them because there really isn't a good way for you to cover the downside possibility on the stock that you own. That's why the other two trades are specifically option-only trades because they give us a few more options as far as what we do to protect ourselves from losing money. So the reason I would probably look at closing this trade specifically is that I hate when a short-term trade idea forces you into a long-term trade. So a lot of people avoid short-term losses, so they leave the trade open, but then they find themselves in a long-term trade when it continues to lose money. Don't do that. It's a bad habit. I've watched a lot of guys ruin their trading career. Just take the loss and move on to the next decision. Now, the next two trades actually did quite a bit better because we sold a call spread and we also bought a put spread. And given the fact that the market dropped quite a bit this week, those two trades obviously made money. So the credit spread we looked at was on Advanced Micro Devices, symbol AMD, Apple, Michael, David. The stock was trading for $23.66 when we looked at selling the November 25-26 call spread, collecting 36 cents. AMD stock fell $6 this week, $6.03. It ended the week at $17.63, and this is definitely proof that sometimes it's just better to be lucky than smart. I expect the stock to go lower. This could not have been planned for or even foreseen. The call spread, which we sold for 36 cents, can be bought back right now for 3 cents, locking in a 33-cent profit. That's 90% of our expectation on this trade. So this is the perfect example of a reason to close the trade. We would have to wait 4 weeks to earn the other 3 cents while still running the risk of the stock price moving against us. So the prudent trade to make is to actually take the profits and lock in the profit on this trade, and definitely start looking for your next trade. The next trade we looked at last week was the debit spread on eBay. With eBay stock trading for $28.75, we looked at buying the November 30-29 put spread for 63 cents with a maximum gain of 37 cents, or that represents 58% return on our invested capital. Now, eBay stock fell $1.41 this past week. That means that the in-the-money put spread, which we bought last week, is even more in the money right now. Now, prices have not really increased in the option significantly because there's still 4 weeks left in this trade. I would keep this position on and just continue to watch the stock. As long as this stock finishes lower than $29 per share, this trade will expire worth $1, and you will have made your 37 cents or 58% return on your investment. So that's great money for another 4 weeks. Now let's look at the trades for this upcoming week. We're going to start off with the covered call, and the caveat, of course, is everything that I said just a minute ago. These aren't my favorite trades, but if you already own the stock, or if you decide to take a short-term look on stock and see about making this money, it can be a great trade. So we're looking at a covered call in Hertz Global Holdings, symbol HTZ, Howard Time Zebra. This is Hertz rental car. The stock is trading for $13.48, and we look at selling the November 14 call at $1.10, which is a roughly 12% return in 1 month. Now, you would enter this trade by buying the stock for $13.48, unless you already own the stock, and then you would also sell the November 14 call at $1.10. You would sell 1 call for every 100 shares of stock that you own. And this trade will make money when stock rises. So we ultimately want the stock to finish higher than $14 per share at November expiration, which I believe is November 16th. At the very least, we'd like the stock to finish higher than the price where we own it from. So we're paying $13.48 for the stock. Let's say the stock finishes for $13.70. That's fantastic because we get to keep the premium we collected on the call option. We obviously own the stock, so we would make the appreciation on the stock, and we'd actually still own the stock next month, so we would go ahead and sell a December call against it and kind of follow the same format. So that's it on covered calls. The credit spread that we're looking at this week is on Teva Pharmaceuticals, symbol TEVA, Thomas Edward Victor Adam. The stock right now is trading for $19.70. We're looking at selling the November 20.5-21 call spread and collecting 15 cents. Now, you would enter this trade by selling the November 20.5 call at $1.05 and then buying the November 21 call for 90 cents. So each of those spreads is 15 cents. This is a credit spread because we are selling the spread. That means we receive money when we enter this trade. And this trade makes money if stock prices continue to head lower over the next 4 weeks. We want stock prices to finish below $20.50, which is the lower strike that we are short. We will have sold. And our final trade for the week is going to be a debit spread on VanEck Vector's Oil Services ETF, symbol OIH, Oscar Isaac Howard. The stock finished the week at $21.14, and I'm looking at buying the November 21.5 put spread for 31 cents, with the hope of collecting the other 19 cents in the spread, which is a 61% return in 4 weeks. So you would enter this trade simply by buying the November 22 put for $1.29 and then selling the November 21.5 put at 98 cents. This is a debit spread because we are buying the spread. We're paying money. We're paying 31 cents to start. And this trade makes money if stock prices stay below $21.50 at expiration, which is in 4 weeks from today. So that is it for this week. Once again, I'm so happy you guys listen. I hope you're following along and actually trading. If you have any questions, email me at eric@theweeklyoption.com. And I also offered a option trading payoff graph Excel sheet each week to look at my trades and see where I make or possibly lose money. And it's a great tool to be able to visualize what you're putting on in the option markets. If you'd like a free copy of that, just email me at eric@theweeklyoption.com and I'll send you an email with that Excel file in it. That's it. Thanks so much for listening. Take care. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.